Hi guys, welcome back to another video. A lot of REITs have just recently announced results, and Mapletree Industrial Trust is one of my focus because I invest in it. However, it sucks to see that the dividend drops by quite a bit. So let me share with you some of the red flags that I read from the balance sheet and from the earnings call as well. So a lot of things has been happening throughout the world and is impacting every REIT as well. So one of the main thing is, as you can see, savings bonds are being more attractive and giving a interest rate of 3.08 to 3.3%, and that's free cash. That's a very safe asset that a lot of people would go for. Moreover, banks are also increasing their interest rate. As you can see, OCBC has announced a 360 savings account increase in interest rate, and is up to 4.65% per year on the first 100,000 in your bank account. So imagine earning 4.65% just by putting 100,000 cash in the bank account. That's a very ridiculous and safe amount to earn from. So because of all these effects, all the REITs have further dropped in share price from the time of my previous video. Because of this, their dividend yields would go up. However, we also have to take note of the interest rate impact that will hit them in the future. But because of this, all the share price have dropped because of fear as well. So in my opinion, it's actually a very good time to look and observe into different REITs and their management. Do follow on my Excel sheet as well in the link below. I've also explained on the previous video on how I came up with the Excel sheet and all the constant updates that will be throughout the period that I've monitored the REITs. So let us look at the key highlights. So as you can see, the distributable income increased by a small margin of 0.7% year over year, where the highlight is at the DPU, which dropped by 3.2% year over year. However, one of the good things that they have mentioned constantly is that the Singapore portfolio has improved in occupancy rate to 9.56%, and this has been a record high amount, which shows that the management is doing well in Singapore markets. However, for the US markets, it has dropped from 94 to 93.1%. This was because there was a withdrawal in one of the tenants itself, and this was one of the concern that a lot of analysts actually are questioning about. However, management are confident that the vacant space will be taken out by someone. So focusing on the capital management update, 74.2% of the loan has been hedged, up 2%, with the average tenors of 4 years. And they have also raised 40.2 million from DRP at a take-up rate of 42.9%. However, majority of it has been taken out by Mapletree investment, as mentioned by the management, of 25%. So they have also released about 6.6 million of tax-exempted income over 3 quarters for the quarter of the years of the next 3 quarters to mitigate the rising operating costs and the borrowing costs, which I will elaborate later on. Okay, so looking at the sustainable and growing returns, obviously you can see that there's a small dip here from 3.49 to 3.36, which is announced by them, and that's a 3.72% drop in DPU, which can be a bad thing as it drops more than what was expected. So let's look at the balance sheet. Because I normally don't like to compare year over year, I would rather focus on quarter over quarter. So as you can see, from Q1 and Q2, the revenue increased by 4.6%. However, the operating expenses increased ridiculously by 19.2%. And because of what? Because of high utility costs, especially in Singapore, of all the high-tech buildings, all the electrical bill, all the air conditioning. So how did the management are now trying to mitigate it is by increasing service charges to customers. So it charge them more so that they can mitigate all these extra utility costs. Whereas the good thing is that for the US wise, the data centers are not as impacted as much as compared to Singapore's buildings. So because the expenses increase faster than the revenue, it has caused the profit to drop of 6.9% before tax and after tax of 4.6% decrease. And this resulted in a lesser amount of distributable income, where a drop of 3.4% and a DPU drop of 3.7% because of the DRP schedules. That's why it results in a higher drop in distributable income because there are more units being issued as well. So let us focus on the debt profile because this is something that a lot of analysts are focusing on as well. Because you see the good thing is that the average leverage ratio dropped from 38.4% to 37.8%. However, this was offset by the increase in the asset valuation of 7 million and the DRP that was used to mitigate the amount that was being loaned. However, if you look at the debt currency, 80.8% is considered US borrowing, and a lot of analysts are asking how is this going to impact the interest rate increase. So this can be a very big red flag, is that this 80.8%, this high exposure of US currency was exposed is to use it as a natural hedge because US dollar is a very strong currency. However, because of this, a Fed increase in the US would have a higher impact to the debts, and as the US dollar becomes stronger, payments in SG would also be higher. However, one of the minor good things that the management argue is that with the US debt, it helps to reduce taxes. But I would feel that because of this high amount of debt, as the dollars become stronger, it also naturally makes the payment harder. So they also said that 25% of the US debts are hedged intentionally. So because of this, only 74.2% of the debt is being hedged from the previous slides. Okay, so if we look at the debt maturity profile, this amount here, 350.1 million, that is going to expire next year, January, is the highlight that a lot of people are concerned with. And they are saying that they are refinancing. They are currently still negotiating in the terms of financing. However, they are hopeful that this debt won't increase the cost of debt by so much. So if you are a MIT investor, please take note of this amount, because this amount next quarter would be increased by quite a bit. They are hopeful that it will be less than 50 basis points or 0.5%. So it's very important to see how the next value will come out to be, and I feel that because of this, the share price has dropped quite a bit. Moreover, this will also result in a drop in the ICR, which is the interest coverage ratio as well. So if the people see that the ICR drops a lot, people would definitely not like it, especially for investors who are looking for safe investment. Another important thing to take note of is the tenant base. So the tenant base, especially for AT&T, so they have a majority that is gonna, so this major tenant is going to expire in 1 year. So analysts are actually asking about how they are dealing with the expiry, or is there any extension. So currently they are in negotiation and they will expire in 1 year. So do keep a lookout on the updates of the major tenants, because this is quite a big amount of income as well. So another main concern that result in the MIT drop in share price is because of the slowdown in tech companies. Because of the drop in revenues, they are spending less, especially on data centers. And you can see from the results of the semicons where their results are much worse than expected. Because of this, indirectly, MIT might be affected, but we do not know until the impacts comes in. So for the rental reversion, especially in Singapore, they have, the good thing is that for the after renewal, they have increased, as you can see from the different sections. However, the new leases, if you take note, they are at a lower value. So the management actually give a very good strategy of why the new leases are coming in at a lower price. Firstly, they want to have a reduce in rent to push tenants to come in earlier, which might be the reason why their Singapore occupancy rate goes up. It's a good thing because I feel that at the current environment with the risk of recession is better, rather it's better for them to get more tenants and to get some income rather than leaving the office as empty and not generating any income. Moreover, they are more selective in their tenants, which is a good thing, so that to get good quality tenants as well. So with regards to their redevelopment of Kolam Ayer 2, they have said that of the 163 Kallang have more than 25% secured with a good brand name. This is a good thing because this means that even before the development finish, tenants are actually already coming in and applying for it. So they have said that based on the anchor tenants of this building, they are expecting the first income to come in at 1st April of 2023, which means that second quarter we will be starting to see the additional income coming from these 3 buildings, which is a good thing for future dividends. So in summary, because of all these headwinds, MIT has dropped recently by quite a bit and giving a very attractive dividend yield that is normally not given in the last few years. Moreover, I'm also still optimistic with regards to data centers as well. So because of this, I won't be afraid and I would be more happy that I'll be able to add more to the companies. With the expected dividend of 6.11%, it's actually a very attractive yield that has not been available for the past few years. However, we cannot mitigate the fact that the interest rate will increase more in the future, especially in the upcoming 2 months by the Fed. So this would naturally cause REITs prices to drop because their current yield will not be as attractive. Because I've mentioned before, bonds and fixed D, especially in banks, interest rate would make it a safer asset, and people would split their cash and park some in safer assets as compared to REITs. So because of this, people will start selling REITs and putting it into other assets. So this is one thing that every one of us will need to take note of. However, in the long run, I feel that as long as you keep hold of the REITs and buying it at good dividend yield prices, it will definitely pay off in the future. Thank you so much for watching. I hope this video provides some insight into the MIT earnings and the earnings call as well. On to the next video.